In today's video, I'm going to walk you through the 5 most important moments from the latest Federal Reserve FOMC meeting and explain what they could mean for interest rates, inflation, the labor market, and the overall U.S. economy. Let's start with the biggest headline. The Federal Reserve decided not to cut interest rates at this meeting. That decision was widely expected, so there was no major surprise there. But the real story was not just the rate decision itself. The bigger story was the Fed's updated projections and what Chair Jerome Powell said during the press conference. And that is where things start to get interesting. At this meeting, the Fed released updated economic projections. They do not do that at every meeting, so this one mattered more than usual. Before we dive in, subscribe to Bridgeport Finance Channel. So back in December, the Federal Reserve projected that the U.S. economy would grow by 2.3% in 2026. Now they have revised that forecast slightly higher to 2.4%. On unemployment, the Fed still expects the rate to finish the year at 4.4%, which is unchanged from its earlier projection. In other words, they are still expecting a relatively stable labor market through the rest of 2026. But inflation is where the shift becomes more important. The Fed now expects slower progress on inflation than it did before. PCE inflation is currently at 2.8%. Back in December, the Fed believed it could bring that down to 2.4% by the end of 2026. Now it is projecting 2.7% instead. Core PCE inflation is currently at 3.1%. In December, the Fed expected that to fall to 2.5% by the end of 2026. Now it is forecasting 2.7%. So the message is clear. The Fed still expects inflation to cool, but not as quickly as it previously hoped. And remember, its long-term target is still 2.0%, which policymakers have been talking about for years. Now here is where the meeting becomes even more interesting. Even though the Fed is now expecting slower progress on inflation, it is still projecting one interest rate cut in 2026. That raises an obvious question. Why would the Fed still expect to cut rates if inflation is proving more stubborn? That question came up during the press conference, and Powell's answer matters. But before we get there, let's look at one of the first major topics that reporters asked about: oil prices. One reporter asked how higher oil prices and rising diesel costs could affect the Fed's decisions going forward. This is important because diesel affects transportation, and transportation costs can push up the prices of food, goods, and many everyday items. Powell's basic message was simple. The Fed is watching it closely, but right now it does not know how large the impact will be or how long it will last. In other words, the Fed is in wait-and-see mode. Powell made it clear that oil and fuel costs can feed into inflation in real and meaningful ways. They may hit headline inflation first, but they can also leak into core inflation over time. Still, at this stage, the Fed does not yet know whether this will leave a major mark on the U.S. economy. That uncertainty is one of the biggest themes from this meeting. The next important question was whether the Fed plans to simply look past higher oil-driven inflation, especially if those price increases are linked to conflict in the Middle East. Powell's answer was more nuanced. He said the Fed is very aware that inflation has remained above target for about 5 years now, and that several shocks have repeatedly interrupted progress. First, there were earlier inflation waves, then tariffs, and now potentially energy-related pressure. What the Fed wants to see this year is clear progress in goods inflation. Powell said officials are looking for signs that one-time tariff effects are moving through the system and fading. That is one of the main areas they are watching to judge whether inflation is truly moving in the right direction again. He also said that the question of whether the Fed can look through higher energy prices depends on the broader context. Normally, central banks can sometimes ignore short-term energy shocks if inflation expectations stay under control. But after years of above-target inflation, the Fed cannot treat that decision lightly. So again, the message was cautious. The Fed may eventually decide to look through an energy shock, but not automatically, and not without carefully weighing the bigger inflation picture. Now let's come back to that big contradiction in the projections. If inflation is expected to remain higher than previously forecast, and unemployment is basically unchanged, why is the Fed still projecting a rate cut this year? That question was asked directly. Powell explained that there are 19 officials, and therefore 19 individual forecasts behind the Fed's projections. He also pointed out that while the median forecast still shows one cut, there was movement toward fewer cuts. In other words, some officials became more cautious. His main explanation was that the Fed still expects some progress on inflation, even if that progress is slower than hoped. He said that if tariff-related inflation begins to fade in the middle of the year and inflation improves, that could create room for a rate cut. But he also made one thing clear: those projected cuts are not guaranteed. They depend on what actually happens in the economy. If the expected improvement in inflation does not happen, then the rate cut may not happen either. That is a very important point for investors, homeowners, and anyone watching monetary policy closely. Next came another major issue: the labor market. One reporter asked whether a weakening labor market is becoming a bigger risk than inflation. That question matters because the Federal Reserve has a dual mandate. It is supposed to promote both price stability and maximum employment. Powell did not say that one side is clearly a bigger risk than the other. He pointed to the unemployment rate as the most important labor market measure, and he noted that it has remained stable since September. He argued that in a world where both labor supply and labor demand have shifted sharply, the unemployment rate may be more useful than headline job creation numbers alone. At the same time, he emphasized that inflation is still too high. Core inflation is around 3.0%, and headline inflation is about 2.8%, both still above the Fed's 2.0% target. So Powell's answer was essentially this: the labor market deserves attention, but inflation remains a serious concern, and the Fed cannot afford to lose focus on it. That tells us something very important. The Fed is not yet ready to use labor market weakness as an excuse to cut rates if inflation remains too hot. Finally, Powell was asked how the Fed is thinking about the next meeting, especially with so much uncertainty around global events, including developments in the Middle East. Once again, his answer was centered on uncertainty. He said the Fed will learn a lot between now and the next meeting, especially over the next 6 weeks. What happens globally, especially with energy markets and geopolitical risks, could meaningfully affect the economic outlook. But he also said very clearly that the Fed does not yet know how those events will shape its thinking. That means the next meeting will depend heavily on incoming data, oil prices, inflation developments, and broader economic conditions. So what is the bottom line from this entire FOMC meeting? First, the Fed did not cut rates, and that was expected. Second, the Fed now expects slightly stronger economic growth and a stable unemployment rate. Third, it also expects slower progress on inflation, which is a problem because inflation is still above target. Fourth, despite that, the Fed is still projecting one rate cut in 2026, but only if inflation improves as expected. And fifth, Powell made it very clear that the Fed is in wait-and-see mode, especially when it comes to oil prices, geopolitical risks, and the path of inflation over the next several weeks. As of now, a rate cut at the next meeting appears to be off the table, while the chance of no cut remains overwhelmingly high. So for now, the Fed is staying cautious, staying data-dependent, and keeping its options open. That is the real takeaway from this meeting. If you found this breakdown helpful and want more updates on Federal Reserve policy, inflation, interest rates, and the economy, make sure to subscribe to Bridgeport Finance channel, like and share. Thanks for watching, and I'll see you in the next video.